It peaked like in 73, crashed into 74. And for 10 years, you could have, it's like kissing your sister. It was sideways, up and down, just didn't go anywhere. Total waste, despite monetary expansion, wasn't compensating for that. But gold and commodities were exploding. They think, that report thinks just what we do, that's where you're headed.
Interesting.
To another one of those, except this one could be worse because the crisis we're facing now, unlike, let's say, 2008 or 9, which was individual family mortgages, is far deeper. It's corporate. It's a lot of large private debt. It's stuff that's hidden. There's mortgage problems out there. We know that. But this is it involves government bonds. You can't let them catch fire and go down and price yields go up. And the T-bond market here is not acting right. It's acting like it's dead. It doesn't respond to stock market weakness like it should. Even when the Fed says we're going to buy it, it won't go up or yields won't go down. What's going on there? It's far bigger than the U.S. stock market and assets. So this is crisis type stuff. And it's out there and it's being acknowledged now. Most stock investors haven't, but I think the game is just beginning. There's you look at the gold price chart anytime you want. You punch it up on your screen, see a weekly or monthly, say, my golly, that's huge. It's got to take a profit. Time to get out, et cetera. The gold trend is, there you go. Naturally you want to get out. If you go to my report, I'll show you a different version of this gold chart.
So here we are, Michael. I've got your chart here of the gold monthly ratio scale since 1975 up. Let's go ahead and walk through some of the significant takeaways here.
Well, and compared to an arithmetic chart, which looks like it's gone ballistic, if you go back and when gold was legalized by the state in January 75, gold was then at 200. It had already gone in the cash markets from like $30 to 200. But anyway, then there was a bear market that took you down back to 100, cut in half. Okay, that was in 1976 summer. Between that low in the summer of 76 and 1980, 3.5 years, gold went up eightfold from price low to bull high. Okay, these are monthly closes, by the way. Now, then it went sideways at a high level, relative to prior history for 2 decades almost. Okay, and then in 2001, with a low at around $260, it surged the second time. And when it peaked in 2011, a longer bull market, but the same dimension, eightfold gain in price, bear low to bull high. Okay. And then it topped and you had to drop back to $1,050 in 2015. And if you measure that as the bear low that, followed that high, we're only a fourfold move. Again, that low was $1,050. We're $4,000. Okay. You go to 8,000 plus, and then you could at least say, gold matched its prior old bull markets in terms of ratio scale. That's not a target on our part. That's just pointing out a feature that people just are not aware of. I think we'll go well beyond 8,000. But anyway, the point being here, quit talking about gold being overdone. Okay. And then there's a more important chart, the one we're really, MSA looks at momentum and structure. But in this case, what we're looking at is simply price versus price, a spread chart. And back in 2013 in particular, gold was collapsing. Peaked in 2011, went sideways 2012, and really started to come apart in 13.
And this is gold. And this is gold divided by the S&P.
Yeah, so take a front month gold future, divide its price into the S&P, express it as a percent.
Right. So anytime the chart goes down, it's the S&P outperforming gold.
And gold underperforming the S&P in this case. We could have flipped it the other way as well, but in which case you'd have a topping pattern as opposed to a bottoming pattern by gold. But anyway, you can see that since 2015, when gold made its bear low in price, that was when it was just above 50% there. It was right where gold price actually ended the downside. If you go sideways from there for 10 years, you've been either side of that level equally. Meaning, it depends on when you look at it, but gold's been par to the S&P. It's done just as well as the S&P with ebbs and flows, better times, worse times, but sideways. Now, but in that period of 10, 11 years, I count 1, 2, 3, 4 highs that define a gradually declining resistance line. We hit it back in April. That's when gold was surging in net price. That's when we hit it the last time there. That's April of this year. No, the other time. There they go. That's when gold was surging in price when the S&P was dropping 20%. That's not supposed to happen according to common wisdom. You know, when the S&P gets kicked bad, gold should go down too, right? It's falsehood. Anyway, you did back off from there, and gold went sideways in price for, 5 months. It hit 3,500 and just went dead. Constant selling, but no real sustainable downside gains for the bears. Now you're intra-month with a week to go in the month. You're at 61%. You close a month at 60% or higher, dividing December gold future into S&P. And that's a breakout. So what this chart is telling you is if this were a price chart and the average guy looked at it and say, oh boy, this is a major breakout, I got to buy this thing. Well, that's right. It's telling you that gold is, well, it's been doing okay versus the S&P for a decade in real terms, up and down, but sideways. It's breaking out. This is just starting. This isn't some old game. It's just starting. That's a fresh breakout. Again, if this were a price chart and you saw that happening, you wouldn't say something's about the end. You'd say something's beginning. Okay. So what this is telling us is there's a major asset class shift out of especially the U.S. stock market bubble, which is probably the biggest one in the world. Many other markets don't have bubbles like we do. They're up like us, but not bubbles. And into monetary metals. We've already seen evidence of that. You know, the last couple of years, gold's been doing well versus S&P, but it's only begun. We've just broken out of the massive base. So when this breaks out, it's likely to happen this month. All you do is hang around on the spread and it breaks out. This thing's going up for years. You don't have a base like this that go up for 2 months and then fail. This is a start of something. So it's an investment grade smack in the face. Reality's changing, guys. Something's going on.
Gold's first modern bull run, beginning after the 1976 low, multiplied prices eightfold in less than 4 years. The next great cycle, starting in 2001, repeated the same magnitude, an eightfold advance into the 2011 peak. After the 2015 pullback to roughly $1,050, gold has completed only half the historical pattern, rising just fourfold so far. If previous cycles are a guide, the long-term structure implies potential for moves well beyond $8,000. This isn't a price target, it's a structural observation. The larger message is clear. Long-term momentum still resembles the beginning, not the end, of a secular expansion.
It's also when you hit those levels before and you go about 6 months to the right, you're not fooling around. You're headed down. Okay. That resistance wasn't, you didn't come back a second time and get back above the first peak. Each time you hit it, you didn't get back above the peak that hit it. You started down. And either that meant gold was going down in price or gold was going sideways. Like from that 2020 high, collapse in the spread was big. Gold also went down, it went down 20% in price from over 2,000 to just above 1,600. But it also dropped a lot versus the S&P was firming then. Okay. In fact, S&P was making a high and NASDAQ 100 was making a price high in late 2021 when that spread was below 40%. That lowest reading you see there. That was a coincidence, but gold go down and stock market making a peak, price peak. Anyway, since then, you pulled up, built a base, a little mini base there, and you broke out of that back in March of this year, earlier this year, and then surged up to the April high. But this time, instead of falling down away from it and continuing down, you're back above it. It's a statement of intent. Okay. Anyway, this is a table pounder, and this is the kind of thing that if you're thinking of investing long term, it's saying you need to reorient your thought process. Something's going on here.
For more than a decade, gold's performance relative to the S&P 500 has moved sideways. neither dominating nor lagging decisively, but beneath that stability lies a compression pattern marked by 4 declining peaks. In 2024, the ratio pressed against this long-term ceiling again as gold strengthened while equities struggled, defying the belief that gold must fall when stocks do. Now, the line is breaking. A monthly close above resistance signals a historic regime shift, capital rotating out of bloated equity markets and into monetary metals. In ratio chart terms, this is what the beginning of a new asset cycle looks like.
So, there's a lot of room. And there's another spread we're watching also, if you want to flip a few pages beyond in that report that we were looking at. This is a very informative chart. It's effectively hit what it's saying is zero. Okay, I'm not going any lower. Okay, this is a spread chart here versus silver versus gold, the top chart.
Okay.
Top chart's a spread chart. And it's week to week instead of month to month. And we go back to 2020. And back then, that's when silver and gold both surged into late 2020. And gold went up 40%, but silver doubled. Okay, so this spread went, ooh, wow, an explosive move in a handful of 6, 7, 8 months, okay, in terms of percent gain in price and percent gain on the relative basis. But then in late 2020 and early 2021, the spread peaked at 1.5% thereabouts and dropped. Now, silver also, like the miners back then, while gold went into a range for a couple of years, sideways range, up and down. Silver and the miners went into a more or less staircase decline. And it particularly shows on the spread chart. So while gold was sort of going lateral, they were sort of going staircase down. So the spread deteriorated. Now, during that time, silver was going up in net price. I mean, you can go back to, 2022, there was a low there at 1.05%, but, the spread's above there now.
And just a quick note for the audience. Yeah. This is another ratio chart that we're looking at. So anytime the chart goes down, that's when silver's underperforming gold.
It could be going up in price at the same time.
Right.
But it's still underperforming. Now, recently, you'll notice since March, April of this year, which is when gold stalled, remember, at 3,500, the spread has exploded from what are historically very low levels for that spread. Getting under 1% is like, it ain't going free, okay? Right. You're buying something that's next to free. So silver shot up, and it's now, this is last week's close, marginally above a downtrend going back to 2021. But the better line in our assessment is that green line, the horizontal. Mm-hmm. And that line gets taken out. We're dividing these silver into these gold and expressing it as a percent. That's how you come up with this number. 1.32%. You ever see a weekly close of December silver versus Dece gold that puts the spread at 1.32, blows out that ceiling that goes back to 2022. 3-year ceiling, perfectly horizontal, very clear. Okay, but already it's taken out a trend line. Now, if you'll scroll to the chart below, it's momentum of that spread. Okay. What we do is we take those spread readings you saw above and plot them in their relationship to a 40-week moving average of the spread. Okay, mm-hmm. 40-week average is almost like a 200-day line or a 3-quarter average. So is the spread above that average or below it? And you oscillate it accordingly. And notice that it's created the same horizontal structure. The only difference is we're at it. Momentum almost always leads price.
Within this monetary shift, silver is preparing to assume leadership. Ratio charts comparing silver to gold show the metal emerging from historically depressed levels, conditions from which past silver booms have launched. Momentum indicators reveal a breakout forming beneath the surface, often a precursor to dramatic price action. When silver outperforms gold, miners linked to silver typically experience explosive moves as they catch up to their gold-focused counterparts. Today, silver miners remain below their 2011 highs, while gold miners have already surpassed them. The setup suggests a powerful repricing phase ahead for silver and silver-linked equities.
So just so I'm reading this chart correctly, and for the sake of the audience, this is telling us that we are right at the 40-week moving average.
No, the 40-week is the zero line. The level that's important there is about 1.32%.
Okay.
It's about 0.14. You can see the scale to the left. Okay. So if silver spread closes 0.14% above the 40-week average, which is the zero line, it will blow that ceiling. And we hit it about 3 months ago, backed off, and right now we're pressing at it again. Now, you close a week out on the spread chart at the top, about 1.26%. It's going to cause this spread momentum chart to break out. Almost always when you have a momentum breakout, the spread will follow. Or if this were momentum of price, then price would follow. So we're focused also on the momentum of the spread, because when it breaks out, that gives us a heads up. Expect the spread chart itself. Now, what does this mean? It means as gold enters a massive asset shift favoring itself versus stock market, within the monetary metals, silver's about to shift into a leadership position. So yeah, gold thumbs up, but silver 2 thumbs up, because it's going to beat gold. So if you're focused on monetary metals or miners, my personal emphasis is on silver and silver related, as opposed to gold and gold related. So anyway,
so silver miners over gold miners.
Yes, they're lagged. For instance, right now, if you look at the SIL ETF, the silver miner ETF, it's not above its 2011 price high. SIL, 2011 high. You can see it over there to the left. We're not above it. It's a 90 something. We're trading in the 70s. Okay, GDX, if you hit it, which is the gold miner ETF. That's not it. Global X, that's silver miners still. Okay. GDX, there you go. It's above its 2011 high. So the gold miners are beating the silver miners right now. But what we're arguing is that when the spread breaks out favoring silver, you can bet that the silver miners are going to do a sudden catch up to what GDX has already done, namely blow the hell out of all highs in history. Okay. And SIL isn't even above the 2011 high. Don't be negative because of that. Yes, it's been lagging miners. But if that silver spread breaks out versus gold, and we also run spreads of SIL versus GDX, it's on the edge of breaking out too. So I think there's a shift underway here.
And here's SIL versus GDX.
Yeah, if you take go back to 2022, you can see that, right there, there's 3 years worth of action you're seeing. Look at what's going on. It's a slightly declining relationship. It's really not collapsing. Yeah, that trend line is important, because if you draw it right, you're right. Yeah, there you go. It goes through 4 highs, high closes, monthly closes on the spread, the green candles you've got there. And we've backed off from it. Okay, you close a month out at about 93.6%. GDX expressed as a percent of the price of SIL expresses as percent of the price of GDX. This spread breaks out of what we would determine to be a 3-year gradually declining base or channel. And I think you would explode up out of that spread relationship, meaning the miners will catch up to the gold miners, silver miners will catch up to the gold miners. And I think they'll do it sharply, because this little structure here is very potent, very compressed. So anyway, that's MSA's thoughts on the monetary metals right now.
Mining equities often reflect not just metal prices, but energy costs, leading some to assume rising oil prices threaten mining margins. History tells a different story. During several of gold's strongest bull markets, oil also surged, yet miners climbed anyway, as rising bullion prices overwhelmed cost pressures. Current correlations remain inconsistent, suggesting oil is a minor factor compared with the larger forces driving monetary metals. Meanwhile, the broader commodity complex is showing signs of a second major uptrend. A breakout in crude above key levels could confirm a widespread commodity resurgence, further supporting gold, silver, and mining stocks.
Fascinating stuff. And clearly the miners are a function of the metals price as well as energy prices, like oil. Does your prognosis on the mining stocks preclude a worsening off in oil or not necessarily?
No, we go back and we ran charts on that a few months ago where we looked at crude oil futures and GDX, I think it was. And the correlation was not good. In fact, during some of the biggest moves in GDX, like a run up from 2000 to 2008, crude oil was exploding during that time too, big time. Okay, there's more examples of that. So sharp rise in oil, yes, it will affect the profit margin of the miners, but it's such a trivial point compared to the bullion price they're getting now and their cost of production. Oil is a little teeny shin kick, if you will, compared to.
Yeah, you're right. I mean, I have oil in yellow, and then I have GDX here in blue. Actually, let me make it a different color just to kind of.
But look how the decline in 2016. Oil was going down along with the miners, and it was going up, down, up, down. I mean, there are too many correlations here that fit together, not opposite.
Yeah, exactly.
And I think oil's about to break out. If you get up above 63 by much, I think you could get a breakout. And so it and commodities are turning up right now. Oil's not. Oil's a laggard. But the commodity index is, in our assessment, starting a second major up leg. And by the way, I'll pass along a comment, and I wish I knew the name of the report. There's an Asian market report I heard quoted on Bloomberg the other day. And the report had a summary statement about things changing in a big way. And it noted that money supply globally is continuing to increase. So it is in the U.S. too. The U.S. Fed has just announced they're quitting their tightening period. And the Fed president of New York Fed said last week, they're going to start buying T-bonds. Somebody's got to support that market, okay? He said it was because of, quote, illiquidity, but whatever his excuse was, they're going to start buying T-bonds. T-bonds have not been a good alternative to the stock market. They've not been that 40% balance, okay? But this report also cited aggressive monetary policies popping up in country after country. We know Japan is going berserk. In fact, a new woman who was elected prime minister there, she's more or less a reflection of Trump. That same kind of sentiment occurred to get her boosted into prime ministership. And she declared, we're going to print. Okay? Well, I mean, okay. So the world is headed into a monetary excess, spend, whatever it takes to keep certain things from collapsing, especially their government debt markets.
Yep.
Oh, there you go. Your money stock.
Yeah. I've got the U.S. M2 money supply. I've got China. I've got the Japanese money supply.
Oh, the Chinese are back in it too. Yeah. The Chinese do not have a stock market bubble. Their stock market is roughly 2 times where it was in 2009, Shanghai Composite. But they're printing because they've got a real estate problem.
Yeah, and you've got China here in blue. I mean, that's been skyrocketing.
Yeah,
but they're all going up. And it's not just ours.
But the conclusion of this report was, this is a perfect environment for stagflation. You remember that late 70s? Mm-hmm. Okay, you don't, but I mean,
I know of it. I don't remember it.
No, okay, you don't remember, but that's when commodities rose and gold rose, and it's. Commodities rose and gold rose, but it didn't, the stock market was a wasteland. It peaked like in 73, crashed into 74. And for 10 years, you could have, it's like kissing your sister. It was sideways, up and down, just didn't go anywhere. Total waste, despite monetary expansion, wasn't compensating for that. But gold and commodities were exploding. They think, that report thinks just what we do, that's where you're headed.
Interesting.
To another one of those, except this one could be worse because the crisis we're facing now, unlike, let's say, 2008 or 9, which was individual family mortgages, is far deeper. It's corporate. It's a lot of large private debt. It's stuff that's hidden. There's mortgage problems out there. We know that. But this is it involves government bonds. You can't let them catch fire and go down and price yields go up. And the T-bond market here is not acting right. It's acting like it's dead. It doesn't respond to stock market weakness like it should. Even when the Fed says we're going to buy it, it won't go up or yields won't go down. What's going on there? It's far bigger than U.S. stock market and assets. So this is crisis type stuff, and it's out there, and it's being acknowledged now. Most stock investors haven't, but I mean,
Global monetary conditions are shifting rapidly. Central banks from the US to Japan and China are returning to aggressive money expansion, reacting to slowing growth, sovereign debt stress, and fragile credit markets. Rising money supply amid weakening productivity is the environment historically associated with stagflation, a period the 1970s made infamous. In such cycles, equities stagnate while commodities and precious metals surge. Unlike past episodes, today's risks include record corporate debt, unstable government bond markets, and geopolitical fragmentation. These forces converge into a single message. The monetary system is entering a new era, and gold and silver stand at the center of it.